let's go. So, you guys can see my screen, right? Just show thumbs up if you can see my screen. Okay, good. Right. So today we are going to be dealing with the double entry system. Just a little part one, just so you guys, can get the gist of things and understand just the basics of this chapter. So we are going to be looking at the double entry system. And before we continue, I just wanted to say happy Valentine's Day, everyone, to all of you guys who did not have, a Valentine or whatever. This is from me to you. Happy Valentine's Day. Yeah, happy Valentine's Day, guys. If you did not receive any love, receive love from me now. This is me saying happy Valentine's Day to you guys. All right. Thank you. I love the hearts. Appreciate it. Okay, let's go. Now, when we are looking at the double entry system, there is this one equation in which everything concerning accounting, concerning just this double entry system as well, revolves around. And it is the accounting equation, right? I'm sure those who did accounting, you guys know this accounting equation. This is your daily bread. You should know this equation from the back of your hand. Why am I saying head? Guys, it's a Friday. You can feel like I'm also feeling the symptoms of Friday. Even I'm mixing up my words. So you should know the accounting equation like the back of your hand. This, if I were to wake you up at a random time at night, you should be able to know this. And yes, this will be posted on YouTube as well. I think so. But just keep being in the meeting just in case it might not, but I think it will. So the accounting equation is what accounting revolves around. You should know this, right? And the simple way of talking about the accounting equation, or the simple accounting equation, it is assets are equals to liabilities plus equity. Now, before you look at everything else that is on the screen, the share capital, retained earnings, income, expenses, I just want you to focus on the main equation, right? Assets is equals to liabilities plus equity. Now, you guys are learning the conceptual framework, so you know these definitions, right? I'm expecting you guys to know these definitions: the definition of asset, definition of liability, equity, income, and expenses, right? So you know what your assets are. Can someone type it out or say it out? What is an asset? Let's just deal with the background quickly so we all know that we are on par. Someone can just say, you can say it out, you can unmute your mic, or you can type it out on the chat box. Just say it. Alright, because of time. Okay, yes, present economic resource. Please continue, because that's not the full definition. Yes, it's a present economic resource, yes. Okay, I'll continue. Yes, an asset is a present economic resource controlled by the entity as a result of past events. Yes, thank you to Olunga and Brilliant. You guys are amazing. Yes, that is what an asset is. It is a present economic resource that is controlled by an entity as a result of past events. Well done, guys. Thank you. And then I'll finish off the rest of the definitions. A liability is a present legal obligation of the entity to transfer an economic resource as a result of past events, right? That's what a liability is. So, for instance, a liability could be a trade payable, where you have bought goods, or you've bought inventory, or whatever it is that you've bought it on credit. Trade payable, that is a liability. And then we've got equity. Equity is basically what my second year lecture likes to say, is that equity is like the thing that we don't really care about, because it's just like your assets minus your liability, that's your equity, right? So it is the residual interest, right, in the assets of an equity after reducing or deducting all of the liabilities, all of its liabilities. That is what equity is. Now, this, what I've got here on the screen, right, is just a more complex way of looking at the accounting equation, right? It's just all of these other added things, just so that you guys are aware, you can see, right? So under equity, or inside this bracket of equity, right, let's look from the inner brackets. We've got income minus expenses, right? You know what your income is, you know what your expenses are, right? Your income is either an increase in assets or a decrease in liabilities that is going to result in an increase in equity, other than those relating to contributions from holders of equity claim or holders of equity claim. And then your expenses, on the other hand, are just the opposite. They are a decrease in your assets or an increase in your liabilities that are resulting in a decrease in equity, other than those relating to distribution to equity holders, right? Now, when we look at that, right, we're just looking at the fact that we've got income and we've got expenses all under equity, right? Then we also have retained earnings opening balance. And then we also have got share capital and dividends. We're going to go and tackle all of these as we continue on with the lesson, right? So, like I said, everything that we're doing in accounting revolves around the accounting equation. Know this equation, right? You need to know these equations. Let me just give like a simple definition of the rest of those points. So when we're looking at share capital, right, it's just, in a simple way, it's just like investment that is made by shareholders, right, in exchange for ownership, or the amount that is given or put into the company by the owner. That's basically what share capital is. And then in terms of retained earnings, it's the profit that a company will keep for itself instead of like giving it out as dividends. But like I said, we're gonna deal with all of these concepts as we go, so do not be afraid when you look at these terms. And then we also have got dividends, which is a portion of the company's profits that is paid to the shareholders of this company or this entity, whatever entity that we are talking about. So look at this equation, internalize it, process it. This shall be your daily bread. I promise you, when you're looking at this, right, it's going to help you with like your journals, with your general ledger. It's going to assist you even in your financial statements, right? It's going to assist you in everything that you're doing in accounting. Every time you feel lost when it comes to accounting, you look back on your accounting equation and you ask yourself, okay, how is the story that I'm getting, this explanation, or not explanation, but the scenario that I'm getting, what is it doing to my accounting equation, right? Always go back to the basics, just so that you can reiterate and understand that which is going on, right? Now, next, I hope you've looked at this, right? Now, when we're looking at the double entry system, we are looking at what we are doing on the left side, which is the debit side, and we are looking at what we are doing on the right side, which is the credit side, right? So there's two sides to it, and whatever it is that you do on the left, you should do on the right, as in the amounts that you put in should be equivalent to each other, right? They should add up to each other. So you'll see what I mean by that as we go further. Now, looking at that equation that we had first, right, above, before this one, is that our expenses and our dividends were negative on the right hand side. So what we did here is bring them to the left side. Do you guys get what I mean before I continue? So in the previous, let's go back. In the previous, if you look at expenses, you look at dividends, they were negative, right? They had negative signs. So we're trying to bring it to a positive, just so that we make things easier for ourselves. So we take it away to the left hand side, where now they become a positive, where you've got assets plus expenses plus dividends is equals to liability plus share capital plus retained earnings opening balance plus income. Now, do you guys get what I mean by that? That we took everything, we took those two things, expenses and dividends, and we put them on the left hand side. You guys understand that, right? Just show thumbs up so that I can continue. Okay, I only received, okay, there we go. Okay, good. I'm gonna continue now. So we put those on the left hand side just so that we can have positive a positive type of equation. So assets, when you look on the left hand side, our assets are going to increase on the left hand side, which means that on the right hand side, what's going to happen to our assets? They're going to decrease. You guys got that? Simple, easy to remember. So because your assets are increasing on they are positive on the left hand side, it means that if you were to take it to the negative, it means that they are reducing. Then you've got your expenses. On the left hand side, they are increasing. On the right hand side, they are decreasing. We'll do more general so that you guys can see, what exactly we mean by this. Then you've got your dividends. On the left hand side, it increases. That means on the right hand side, it's going to decrease. Then we've got your liabilities. Your liabilities increase on the right hand side, right? Your liabilities, I hope you can see this. Your liabilities, can you see this mouse? I hope you can. Your liabilities on the credit side increase, and then on the left hand side, the debit side, they will decrease. Same with share capital, same with retained earnings opening balance, same with income, right? Income is going to increase on your right hand side and decrease on your left hand side, right? So now, like I said, in the debits and credits, whatever you do on the left side, you must also do on the right side. They need to be especially when you're looking at your, let's say, your journals, you have to have done something on the debit side and you have to have done something on the credit side, of which results in the same amount. You will see what you'll see what I'm talking about. And they need, like I said, they need to always balance, right? What you do on the left is what you're going to do on the right. It's giving mathematics equations, right? What you do on the left, you do on the right as well. Now, an example of this is that we look at vehicles, right? Let's look at an example of vehicles. So let's say you bought a vehicle for cash, right? You bought a vehicle for cash. If you're buying a vehicle for cash, a vehicle is an asset, right? Just want to check if you guys are like, vehicle is an asset, right? Thumbs up. Yes, exactly. So, right, vehicle is an asset and you bought it with cash. So the two things that we are dealing with is vehicles and we're dealing with bank, right? Those are the two accounts we're looking at, which would mean that in terms of our accounting equation, our assets are the ones right now in this example, they are the ones that have been affected, right? Which means that if we are buying a vehicle in cash, it means that we are increasing our assets by buying the vehicle, but then at the same time we are decreasing our assets because we paid it with cash. So our bank account is losing money, right? Because we paid for this vehicle that is an asset. So I hope you guys get that. Same with a trade payable. When we owe, like when we bought something like inventories for when we bought something like inventories in credit, right? It would mean that we are implicating two types of things. I think, let me get out of this and then also type out something on Word just so that you guys can see. Now you guys can even see my essays. Okay, now just so you guys can also see what's happening. Let's do this. Assets equals to liabilities plus equity. Let me just make this bigger. But I hope you guys are following and you guys see what we're doing here, right? So we were talking about the issue of buying trade inventory. So let's say you bought trade inventories for 100 rand, right? That would mean that you are increasing your assets, right? Right, a plus, let's put a plus, increasing your assets. And you bought it on credit, which means that you are also, I don't know why it's an equal sign, sorry. Okay, plus, yes, 100 rand. And then because you bought it on credit, you are also increasing your liabilities, because that's a payable. That's something that you are due to pay. You have to pay it back, right? So I hope you guys get it. I saw a hand that was raised. I don't know if your question is answered or you still want to ask a question. Are you okay? I didn't see who raised their hand, but a hand was raised. Okay, I'll just continue. Okay, good. It means you're fine. Right. Now, that's just two of the examples that we can go through. And then, so now you know, right? What you do on the left, you should also do on the right hand side. Your accounting equation should always balance. It needs to always balance. I repeat, it must always balance. My accounting trainee from last year would be like, for the even if like, let's say you don't understand something, right? Sometimes you can even get a principal mark. Like rare occasions, you might even get a principal mark just because, like, let's say you were doing a journal entry and your debit and your credit sides were of equal amounts. You can get a mark, but that's like a rare occasion. But make sure that your equation balances, right? Now we're gonna dive deep into some journal entries, right? Just to also illustrate the double entry system through journals. Now, you guys know we've got journal entries. We are going to be recording the transactions as they're going, and right now in accounting we're looking at the accrual basis of accounting. That's how we record our things, based on the accrual basis of accounting, which means that as transactions are taking place, we are recording them irrespective of whether we had an inflow of cash or not, right? So we spoke about this in our last lesson, that in terms of our format for our journal entries, we've got the date, we've got the account, and then we've got the debit and the credit side, right? And then under account, you've got the name of the account that is debited, and then in brackets you put the type of statement, so whether it be statement of profit or loss, statement of changes in equity, or statement of financial position. Same with the name of the account that is credited. You're going to type in the statement of statement of changes in equity, or the statement of profit or loss or financial position, and then you're also going to write your journal narrations, which is basically a short explanation of what is happening in that journal entry, what you did there, and then your debit and your credit needs to both have the same amount, right? Now let's dive deep into this. Let's go. Let's look at an example, right? So in this example, it says that trade inventories to the amount of 20,000 were ordered on the 7th of January 2007. Now, one thing that I want you guys to notice when it comes to accounting, look at your dates. I repeat, look at your dates. Read carefully. The marks are in the detail, right? The marks are in the detail. That's what I can tell you. So you need to read carefully. So I'll repeat that again. Trade inventories to the amount of 20,000 were ordered on the 7th of January 2007. And it was agreed with payable L that the outstanding amount will be paid 30 days after delivery. On the 25th of January 2007, payable L delivered the trade inventories to Focus Ltd premises. The invoice price is 20,000 and the invoice reflects the amount is payable, that the amount is payable on the 24th of February 2007. Now, let's go on to the date. Remember, when we look at the definition of an asset, we can now deduce the fact that, okay, our trade inventories are our assets, right? So when we're looking at the definition of an asset, we say that it's an economic resource, present economic resource controlled by an entity as a result of past events. And you are going to recognize it as an asset when you, as the entity, are able to control the use of that asset. You are able to use that asset. You cannot recognize it as an asset if you just ordered it, because it's not, you don't have it. You are not using it. You cannot direct the use of it. Right? Do you guys get me? Thumbs up if you get me. Thumbs down if you don't, so that I can reiterate this. Okay, cool. Just so, okay, thumbs down. All right. I'll go over this again. So, you guys were looking at the conceptual framework this week, right? And in the conceptual framework, you were learning of these definitions of assets, liabilities, equity, and so on and so on. Now, we said that an asset is a what? It's a present economic resource that is controlled by an entity as a result of past events. Now, that word controlled, right? It means to direct the use of it, right? Just thumbs up, yes. It means to direct the use of it. So you cannot direct the use of something that is not in your premises. You cannot direct the use of something that you do not have, right? For instance, if you've got a phone, right? Maybe that's a bad example. Yeah, let's say a phone, right? You bought a phone from Apple, and it's going to be delivered to you tomorrow. As of right now, you cannot label that Apple phone as an asset because you cannot use it. You cannot control its use, right? You cannot recognize it as an asset as of yet until it comes to your hands, until it is delivered into your hands, right? Later stages, you're gonna learn about long hand delivery, but like that's not something for you to worry about right now. But just know that you can only direct the use of an asset. You can only use an asset once it is in your premises, and you can only recognize it as an asset when it is in your hands, when you can make use of it, right? Yeah. And one point that I can make of this, right? One thing to note about this is that when it is in your hands, right? Whether you use it or not, the mere fact that it is in your hands, it is an asset, right? So sometimes they will trick you with questions, and they will be like, it was delivered on this date, and then they only started using it on the 6th. So let's say it was delivered on the 5th, but then they only started using it on the 6th. The mere fact that it was delivered, it means that you could have used it on that date, which means you will recognize it as an asset on the 5th. Do you guys get what I mean? I hope I'm clear and you understand. Please, thumbs up. If you don't, I will literally repeat this until you are blue in the face. I am, it's something that you guys must always know because it's going to help you. Okay, I see thumbs up. I see a lot of thumbs up. That's good. Now, let's continue. So with this example, it says that the trade inventory was bought, 20,000, it was ordered, it's 20,000 rand, and then it was only delivered on the 25th. And the invoice price of it is 20. It's 20. We already said that, right? And the amount is payable on the 24th. Now, one thing to notice is the dates, like we said, right? So the only time we are going to, in this example, we are going to recognize it as an asset. The date is very important, guys, right? We're going to recognize it as an asset on the 25th of Jan, not on the 7th, because on the 7th we just ordered it. On the 25th, that's when it was delivered to us, and we could make use of it on the 25th. Sorry if I mixed the dates up. On the 25th, that's when we could use it. So when you're doing your journal entry, you're going to write 25 Jan by the date. And then in terms of your account, I forgot to write date by payable. It's supposed to be statements of financial position. Let me just fix that quick. Sorry for that. Okay. So let's go back. Right. So your trade inventories right? We bought trade inventory, so it's going to increase your assets, because trade inventory is an asset. So your assets increase on which side? On the debit side. So increase in 20,000. Lisa, can you please just mute yourself, and anyone else whose mic is on, please just mute so that everybody else can hear. Thank you so much. Right, so your assets are increasing on your debit side, right? That's what we've discussed when we were looking at the accounting equation. It's increasing on the debit side. And then you bought these inventories on credit. Why? Because you didn't pay it immediately when you had it. You didn't. You said that you're going to pay on the 24th of February. So you are going to recognize this the credit side as payable L. It's a liability, right? It's something that you have to pay back. You owe these people the money. So you're going to write payable L. And then remember your brackets. What statement is this going to go into? It's going to go into the statement of financial position. Why? Because that is where we record all our liabilities. Even the same with the trade inventories. In brackets, you're going to write statements of financial position. Why? Because it's an asset, and assets, you take record of them in the statement of financial position. Right? And like we said, you're going to have 20,000 on the debit side, 20,000 on the credit side, so that it all balances out. If you look at the bottom and you look at the accounting equation, the simplified one, assets is equals to liabilities plus equity. Your assets increased because you bought the trade inventory, and your liabilities also increased because you bought it on credit. All right. Now, note, guys, you need to make sure that your date is correct, or else they will subtract a mark. You need to ensure that your brackets where you write the type of statement that this thing will go into are correct, because if it is not there and you leave it out, you will lose a mark. Guys, you will cry. I'm telling you this. I saw many people in first year forgetting to do this simple thing, and they lost marks because of it. They are not gentle to you just because it's your first test. They won't be gentle. They're going to mark it as it is, right? Very different from high school. So don't forget these small little things, because they will cost you guys marks. Do you guys understand? Just thumbs up if you understand, so that we can also go to the next set of examples. Are you guys okay? Okay, that's good. That's good. Now, let us carry on. Let's look at more examples. So, the screen is going to change now. I hope it has changed on your side. Yeah, there we go. More examples. So, on the 2nd of January 2007, the shareholder, Mr. Kondwani, transferred the property that Focus Ltd utilizes into the name of the company. The purchase price of the property was 1,200,000, right? 200,000 was for the land, and 1 million was for the buildings. That is example number 1. So, first things first, we're going to look at the date, okay? 2nd Jan is fine. Cool, we sorted with the date. Then we're going to look at what elements are they that we are dealing with here, right? We are dealing with land and buildings. Land and buildings is parts of your assets, right? So that's one of the elements that you're dealing with, right? And another one, let's read this carefully. It says, Mr. Kondwani transferred the property that Focus Ltd utilizes into the name of the company. Mr. Kondwani is what? He's the owner, right? Because he's the only one who can make a transfer such as that. And it even says so. It says that he's the shareholder, right? So, which means that the other concept that we will be dealing with is share capital, right? Share capital is the other one that we're dealing with. And we said that simple definition of a share capital is, it is an investment that is made by a shareholder in exchange for ownership. So, when we are looking at our accounting equation, let's look at it first, right? Let's do this. I just want to go over here by word. Let's look at our accounting equation. How much is that? I think it was 1,200,000, right? So our assets are increasing, 1,200,000, right? And then another thing that is going to increase, that is part of your equity, right, is your share capital, which is also going to increase by the same amount, 1,200,000. Now, let me reiterate this by looking at the equation that we looked at, right? The accounting equation that we looked at before. Here. Sorry. Here. No, before. Here. So part of equity here, as you can see, part of equity is your share capital, right? So when you come into the accounting equation, like we did here, I'm sorry for going up and down, but I just want you to be able to see your equity is that which is going to be affected, right? And your assets in this transaction, your assets, and then also your equity. Are we fine? I hope we are fine. Okay, that's good. I saw a thumbs up. That's good. So let's go back. So what we are going to be doing in that specific example, right, is that we've got assets in our journal entry. We'd write the date 2nd January, right? And then under accounts, on the debit, the one that's affecting the debit is going to be your land and your buildings, 1,200,000, and then you're going to obviously write that in brackets. That is going to be statements of financial position, and then you are then going to say that the other thing that is affected is your share capital. So that's your other account, share capital, and then in brackets, statements of financial position, because it's also the statements of financial position that we saw, right? Or even, statements of financial position, and then you're going to write the same amount under the credit side. I hope you guys get that. I'm not sure if you guys want me to project this as well, and then just write in the examples as we go as well. Copy this. Let's see if we can also do it on Word. So can I work on this? Right. Yeah, okay, I can. So in this example that we had, this is way too big. Okay. Let's do this. Okay. Okay. The date was, I think, the 7th. I hope it was the 7th. And then we are looking at land and buildings. You could have written it separately, right? And said land, statements of financial position. The amount of the land was, I think, 200. And then you had your buildings as well, which was 1 million. And then after that you had your share capital. And the reason why you're going to write statement of financial position also is because, remember, your statement of financial position has got your equity, liability, and assets. Then here, you're going to write the final amount, 1,200,000. Okay, why is it so weird? 200,000. Alright. You guys get it? Are we all cool? You guys can see? We fine? Alright, let's go. Next example that we are going to have is, it says that on the 2nd of Jan, furniture and equipment to the amount of 225,000 was ordered. Again, we must read carefully. It was ordered on the 2nd of January. The supplier, Payable Z, delivered the furniture and equipment on the 5th of January 2007 to Focus Ltd's premises. The invoice price is 225,000 and it was agreed with Payable Z to pay the outstanding amount on 30 January 2007. Now, the reason why they keep on saying invoice price, you guys haven't really dealt with that. So once you do it, way ahead, I think after your semester test 2 or after semester test 1, you guys will be dealing with that. So it's quite a nice and fun topic, so you don't have to worry about that right now. Let's just focus on this. But I'm just giving you guys a warning. You'll be learning about VAT. Very nice. And after you learn about VAT, VAT is going to be included in every single thing you do. Right? Just a little heads up. Now, you say that on the 2nd of Jan, you ordered furniture for that amount. And then the supplier Payable Z delivered it on the 5th. And then the invoice price is 225,000 and it was agreed that Payable Z would pay this outstanding amount. You agreed with Payable Z that you're going to pay the outstanding amount on the 30th of January. Now, let's continue this because it's part of the same example. On the 30th of January, the amount due to Payable Z was then paid. Okay, so first things first, we looked at the date. We are going, which date will we recognize this transaction? Can somebody type it out or say it out quickly? On which date will we recognize this particular furniture and equipment as an asset when we are doing our journal entries? Yes, 100% Olunga, it is the 5th of January. Why? Because on the 5th of January, that is when that asset is going to be on our premises. Yes, thank you, Snako. Thank you. 5th of January. Good, you guys got that, right? And if you know the dates, it means that you guys have understood your conceptual framework. Because most of the time, they look at the date, okay? Especially when you're looking at an asset. So be careful, even in your test 1. Cool. So, you've got the 5th of January 2007. Let us go and do our work here on Word. So, it's the 5th of January. Is it 5th of January, 5th of Feb? Okay. But you guys know the date, right? Yeah, 5th of Jan. So 5th of Jan, what did you do? You bought equipment. What was it? It was equipment and furniture. Furniture and equipment. Furniture. Look, I can't even spell furniture, guys. It's really a Friday, eh? Like, I'm serious. Okay, furniture and equipment. Right? Furniture and equipment are assets, so statements of profit or loss. And then we bought it on credit, so you're gonna write payable. Who? Payable L, I think. And the amounts are 225,000. Even here, 225,000. Yo, sorry, I wrote it on the wrong side, guys. You must tell me. And then obviously you're going to write your journal narration. We didn't write it the last time, so your journal narration, yes, yeah, Olunga, thank you, you caught that. Yes, we forgot to write our journal narration for the last one. So for the last one, you just literally explaining what was happening in the last one. We bought trade inventory, right? Was it trade inventory? Was it a vehicle? I think it was trade inventory. So you will recognize and just say at the bottom, bought trade inventory on credit. So same with here, you're gonna say recognize trade, not trade inventory, furniture and equipment. I'm just gonna write bought on credit. That's what we have there. Right? Yes, like that. Simple, like that. We are sorted in terms of our accounting equation. Furniture and equipment will go up under assets 25,000, and then under your equity, not equity, under your liability, it's also going to be 225,000. All right, are we sorted with this example? Are you guys sorted? Yes, Everest. Your hand is raised up. Are you okay? Just unmute and let us know what's up. Maybe what you wanna ask is something that another person also wants to ask. I see your hand was raised down, so I'm guessing you understanding a bit. But if you're not, feel free to send something on the chat box. Now, the rest of this story, it says that on the 30th of Jan, the amount due to payable Z, it was payable Z, not payable L, payable Z was paid, right? So you're going to come here. The amount was paid. So because the amount is paid, it means that, let me just fix this, payable K. It means that this payable, you're gonna derecognize it, right? What do we mean by derecognize it? Instead of having, yes, it will be shared, these activities will be shared via the YouTube. So if you want to redo these activities, you can look at it there. So payable K, this guy, right, you have to derecognize it. And what I mean by that is because we don't owe him anymore, because we are saying that we settled the fee, right, on the 30th of Feb. Let me just do the date. 30th of Feb. You guys paid this guy back. So which means that we don't owe him anymore. So we must remove. So here you are going to write payable K. And after you've written payable K, because remember, we said that our liabilities increase on the right hand side, credit side, but they decrease on the left hand side, right? Remember that conversation from earlier on? So you're gonna derecognize it here, and then here you are going to write bank. Why you are asking why are we writing bank? It's because we are paying this guy off. We are paying these people off. So their money, like the money that we owe them, we have paid them back, which means that it's removing money from our bank account and paying them back. So this is how your journals will look like, right? This is how your journals will look like. So you're gonna recognize furniture, and you're gonna say recognize that you have recognized payable K. You can say, you can write anything. You can literally write you recognize or derecognize payable K as your liability. You can literally write anything as long as it makes sense to the problem, right? Or recognize payable K's liability settled, you know, something like that. You can write anything as long as you as long as you are explaining what is happening. So the question that came up here was that so you draw two, yes, the answer is yes, you do draw two journals, because it's two separate things that are happening, right? If you're looking at our questions, it says that on the 30th of January the amount due was paid to this guy, right? So you are going to have two journal entries, the one where you had the equipment was delivered into your hands, and then the other one is when you actually paid the amount. So you will have two journal entries. Now I wanted us to go into general ledgers, but I feel like there's already too much to process today, so we're going to end it at that, and then we're going to have a part 2 for this sometime next week. So if you did not understand, just let me know right now before we end the call. It's going to end in about 9 minutes, so let me know right now. If you do not understand anything, ask your question. Yes, Everest, your hand, Everest, yeah, your hand is raised up. Please let us know your question.
Hello, ma'am.
Hi.
Do we have payable K or payable L when we bought something with like a liability?
Do we what?
When we bought something on credit.
Yes.
Like, why do we write payable something?
Yes, okay, that's a very good question. Thank you for your question. Very good question. You write payable because it's someone. Okay, simple. It's someone you're going to pay, right? It's someone who you owe. So you're gonna write payable because you're owing that person some money, right? You have to pay them something. So I guess that's the reason. I've never really asked myself why. You know that thing of just accepting what your teachers say, but it's because you have an amount that is due to them. You have to pay them something. Same with when you are supposed to receive money from someone, you write receivable. We didn't do an example on that right now, but further going down, we're going to make an example. So when you are being owed cash, when somebody bought goods on credit from you, when you recognize it, you can recognize it as an asset and write receivable. What? I think maybe we can even do that example quick, just so that you guys are aware and you just get the gist of things. So let's say you were there, you rented a service, or you paid good, you rented a service, or somebody bought goods from you, right? And they did not do it through they did it through credit, they didn't pay cash. You're going to write here, because you are supposed to receive that money, right? To you, that is an asset. So you're gonna write receivable. So I'm gonna write receivable Everest, right? Whatever it is, the name they gave you there, right? You are going to write it as that. So you're gonna write receivable Everest, and because it was on credit, right? And then you're just going to say revenue. And revenue is statement of profit or loss. I hope I haven't lost you by doing this example. So, like you said, right, you're asking why is it payable? It's because you are supposed to pay that person. Same with the receivable. You are supposed to be receiving money from those people, right, who you have rendered a service or a good to. They are supposed to pay you. They owe you. So to you, that is an asset. So you're going to recognize it and say receivable Everest, statement of financial position, and then revenue, statement of profit or loss, because imali yangena, that's an income to you, right? And yeah, I hope you guys understand that. Do you guys understand? Did I make things a bit complicated towards the end? I hope I didn't. Okay, that's good. All right, that is it for today. We are going to continue with everything else next week. You guys have made it through the first week of university. Congratulations to you. Always remember why you are here. Always remember, the situation that's back home, because sometimes that is what motivates us. So remember where you come from. Remember why you are here. Remember why you're doing this degree. And yeah, let's make some money. You guys want to be CAs, and I'm sure that the one main reason why you're doing it is to make money. I'm assuming, because that's what everybody says. So let's get the bag, guys. Let's do the most to get the bag. Yes, there's no other reason, period. So let's get the bag and do the most. Have an awesome weekend. You guys have just initiated your road to CASA, as Lisa said. So you are embarking on this journey. It's going to be a tough one. It's going to have ups and downs. But at the end of the day, it's CASA. It's going to end in CASA. So have an awesome weekend, guys. And see you next week. Thank you.